Yesterday we had a spike in channel day, and today we gapped below the channel. Not a really good signal bar for a failed breakout on bar 1. I thought that there probably would be shorts above it because of the big tail. Shorts came in at the moving average. With the 3 up bars, 1, 2, and 3, I thought it was likely that there would be a higher low. To me, even though it's a breakout pullback short, the market was telling us something by having the big tail on the bottom. Bar 5, arguably, you could short below that bar, but my concern is that 1, 2, and 3 were so strong that a pretty good chance the market would try to form a higher low. Bar 6 was right before the report, so I personally did not buy it. I was concerned about a very fast move, and it turned out that the market just hung there, and traders could have bought in the seconds after the report was released. Okay, second push up, strong bear reversal bar at 8, so it's a low 2. Second attempt to have the breakout fail, so it's a second breakout pullback, and it's a short, and it's at the moving average, and it's a strong bear trend bar. So this is a reasonable setup for a high of the day. The range so far is only about 5 points, so the range could double. And so this could be a setup for a possible big move. Great looking entry bar on bar 9, but bar 10 was a problem. Right now we have 8 and 9 being very strong. I think buying above bar 10 on the basis of a high 2 is not likely to be successful. I think there'll be shorts above it. And I would hold my short from 8, at least the swing portion, with a stop above 9. 9 is a strong bear trend bar, so putting a stop above it should be good. The market tried to go outside down on 11, but didn't quite make it. So it had a chance to be a very, very strong bear trend day. A lot of times, once in the first hour or so when a trend is beginning, you'll get an outside down bar in a bear day, or a strong outside up bar in a bull day. And bar 11 had the opportunity to do that, and it failed to do it. So to me, that was a red flag. Bar 12, wedge bull flag with 6 and 9. Not a good-looking body, but it might be okay. 3 up bars to 14, 15 little bear body. To me, I wouldn't short that. It looks like we're in a barbed wire situation, so I think there probably will be buyers below. 17 outside up. I think it's not a great location to buy. At this point, it looks like we're in a relatively small trading range. I think the day will probably become a trending trading range day at this point. 2/3 chance of a trending trading range day, 1/3 chance of just a small trading range day. In any case, I don't want to be buying at the top. I only want to sell at the top and buy at the bottom. 19, this is probably my biggest mistake of the day in terms of a trade that I did not take. I didn't take it because the market went above the 9 high. And I thought if the bears were really strong, they would not have let the market get up there. But anyway, it's a wedge bear flag short, and the market could test the low of the day. Bad looking entry bar on 20, but 21 was a bear bar. On 26, you can argue that 21 is a little spike, and 26 is the end of a channel, and it's a double bottom pullback long. But I think there's too much selling going on for 5 bars for me to buy this. I think chances are there'll be shorts above, but the shorts may find support at the 1 and 12 double bottom, so there's really not a lot of room for a short in there. Okay, the market tried to plunge on 29, but it could be just the bottom of a trading range day and a second entry long, which 30 became. On trading range days, you get high 2s at the bottom of the range. A lot of times the setups don't look all that good, but they grind higher for a couple legs. So if you're willing to sit through the pullbacks, it's an okay long. A low 2 short at 33, I wouldn't take it at the bottom of a trading range day. If the market breaks out to the downside and starts to become a trending trading range day, then I'll look to go short on an always in breakout. A little bit sideways in here. The market's been channeling up from 30. Now we have an II at 45. I think it went III. I think there were 4 of them. Yeah, 47. It was III. To me, I'm looking to short above bars in our trading range day that's been going up for 5 to 10 bars. So I think it's okay to short up here. I don't like shorting below bars. Arguably you could short below 48. I would not do that. 2-bar reversal at 51. Arguably, the move up to 48 was a breakout of that triangle from 8 to 28 or 36, somewhere in there. So this is possibly a breakout pullback long. I don't want to be buying this high up on a trading range day. I think shorting above this bar and adding on a point or so higher makes sense. I think buying up there is risky. Okay, a little expanding triangle with 43 and 48, and now 55. Doji signal bar, I think that's not a great short. The location is good. It's also possibly a double top bear flag with 19. The location is good, but the setup is bad. Market tried to plunge, became an II. Very sideways here for about 10 bars. I'm definitely not shorting this. You can argue it's a second entry short. The market's been holding above the moving average for about 10 bars. You got a couple of bull bars on the II. I would rather see the bears get trapped and then look to buy, and that's what happened. 60 is a 2-bar reversal. Double bottom with 56. I think that's okay to buy. Now we got 4 up bars. At 62, I tried buying again at the low of the bar, and I did not get filled. And whenever I don't get filled on a limit order, it always makes me think that there's urgency to the trade. Sometimes if I don't get filled in the limit order, I then buy on a stop above the bar, because I suspect that traders are really eager to get long, and they're not letting the market get below the low of the prior bar. They're placing limit orders at 1 tick above the low. So, for example, they're placing limit orders to go long 1 tick above 62. 62 is low, rather than at 62 is low, because they're afraid it may not go below 62, and they were right. Okay, I told you about a little math in here that I thought the bar 30 longs should have at least 17 ticks, so that means the market should go at least to 12.21 and a quarter. So a trader could get out of a long at 12.20. That means if a trader bought at they can get out of a long at 12.21. So if they bought at 12.20 or better, they should be okay for a scalp. So I thought that was an okay long. I scalped out. You can argue top of a channel, bear reversal at 67, strong bar. I thought that the range should expand. It's only 5 1/4 points. And there are only 2 days this year with range of that size. Every day has a range of 5 1/4 points at some point, and 99% of those days end up with a range bigger than 5 1/4 points. So chances are today would behave like the other 99% of days and have range expansion. Since we've been trending up for a couple hours, and since the past couple days were bullish, and since we've been holding above the moving average for a couple hours, I thought the odds were greater, maybe 60%, that the breakout would be to the upside. If it collapsed to the downside, I would be willing to short, but at this point I'm only looking to buy. The low 2 at the top of the trading range trapped the bears, and the bulls either bought above 70 or above the 68 II.